War breaks out in the Middle East, markets dip. Panic spreads, but should you be afraid or excited? When conflict erupts, financial markets react swiftly. Oil prices spike as supply fears grip traders. Investors pull out of risky assets, seeking safety in bonds and gold. Stock markets plunge, driven by emotion and uncertainty. But here's the thing, history shows us that market reactions to war are often temporary. Like a person panicking during a crisis, markets overreact in the short term. Long-term trends, however, tell a different story. Let's look at some real-world examples. During the Gulf War in 1990, the S&P 500 initially dropped 16%. After 9/11s, it fell 11.6%. When Russia invaded Ukraine in 2022, global markets tumbled. Yet in each case, markets rebounded within months. Why? Because economies are resilient, companies adapt. And most conflicts, while tragic, don't fundamentally alter the global economic landscape. Consider this, 6 months after the Gulf War began, the S&P 500 was up 25%. 1 year after 9/11s, it had recovered all losses. Even during the ongoing Ukraine conflict, many global markets have shown surprising resilience. So is war a harbinger of market doom? Not necessarily. For long-term investors, it can present opportunities. Think of it like this, when everyone's running for the exits, smart investors are looking for bargains, quality stocks trading at a discount, sectors poised to benefit from geopolitical shifts. Which sectors tend to thrive during conflicts? Defense stocks often surge as military spending increases. Energy companies can see profits soar if oil prices remain elevated. Commodity producers might benefit from supply disruptions. But beware of trying to time the market or make big bets on specific outcomes. Wars are unpredictable. Their economic impacts can be complex and far-reaching. Instead, consider a diversified approach. Exchange-traded funds ETFs like VTI or SPY offer broad market exposure, reducing your risk if any single sector or company underperforms. Remember, investing during turbulent times requires a cool head and a long-term perspective. While others panic, disciplined investors see beyond the immediate chaos. Here's a key principle: markets hate uncertainty. As conflicts unfold and outcomes become clearer, markets often stabilize even if the news remains grim. It's not about the situation being good, but about it becoming more predictable. Let's dive deeper into how wars impact specific sectors. Energy, oil prices typically spike on supply concerns. This benefits oil producers, but can hurt industries reliant on cheap energy. If a conflict drags on, it might accelerate the shift towards renewable energy. Defense, military contractors see increased demand. But be cautious, defense spending can take time to materialize in company profits. Technology, some tech firms might benefit from increased cybersecurity needs. Others could face supply chain disruptions. Consumer goods, luxury brands often suffer as consumer confidence wanes. But companies selling essentials tend to weather the storm better. Travel and tourism, these industries usually take a hit, especially in regions close to the conflict. However, they can rebound quickly once tensions ease. Gold and other safe havens, investors flock to these during uncertainty, driving prices up. But remember, they might underperform once stability returns. Now, let's address a common concern. What if this time is different? What if this conflict leads to a broader war or economic collapse? It's a valid worry. Every situation is unique, and past performance doesn't guarantee future results. But here's the reality. If a conflict escalates to the point of causing a global economic meltdown, we'll have bigger problems than our investment portfolios. That's why diversification is crucial. It's not just about spreading your money across stocks and bonds. Consider geographic diversification too. A globally diversified portfolio can help mitigate the impact of regional conflicts. Here's another perspective. Wars, while terrible, often drive innovation. World War II led to advancements in technology, medicine, and manufacturing. The Cold War spurred the space race and computer development. Even today's conflicts are accelerating progress in areas like drone technology and cybersecurity. For investors, this means keeping an eye on emerging technologies and industries that might benefit from current geopolitical trends. But let's be clear, we're not advocating for war or dismissing its horrific human cost. We're simply examining its potential impacts on financial markets and investment strategies. So how should you approach investing during times of conflict? Here are some key principles. 1. Don't panic sell. Emotional decisions rarely lead to good investment outcomes. 2. Maintain a diversified portfolio. This helps cushion against sector-specific shocks. 3. Consider dollar-cost averaging. Regularly investing a fixed amount can help you benefit from market dips without trying to time the bottom. 4. Stay informed, but don't obsess over daily news. Long-term trends matter more than short-term fluctuations. 5. Review your risk tolerance. If market swings are causing you sleepless nights, it might be time to reassess your asset allocation. 6. Look for opportunities, but don't bet the farm. Buying quality assets at a discount can be smart, but avoid speculative moves based on geopolitical predictions. 7. Remember your time horizon. If you're investing for retirement decades away, short-term market movements matter less. It's also worth noting that not all wars or conflicts have the same impact on markets. A localized conflict might cause regional disruptions, but have limited global effects. A war involving major economic powers, however, could have far-reaching consequences. Consider the difference between the Iraq War and the US-China trade tensions. The former, while significant, had a relatively contained impact on global markets. The latter, despite not being a military conflict, caused widespread market volatility due to the economic stakes involved. This underscores the importance of understanding the broader context of any geopolitical event. It's not just about the conflict itself, but its potential to disrupt trade, alter alliances, or shift economic policies. For example, the current tensions in the Middle East aren't just about the immediate military situation. They're also about oil supply, regional stability, and the complex web of international relationships in the area. Each of these factors can influence markets in different ways. As an investor, your job isn't to predict the outcome of conflicts. It's to position your portfolio to weather various scenarios while capitalizing on long-term growth opportunities. Think of it like sailing a ship. You can't control the weather, but you can adjust your sails, choose your route, and ensure your vessel is seaworthy. Sometimes you'll face storms, other times you'll enjoy smooth sailing. But with the right preparation and mindset, you can navigate through it all. In conclusion, when war breaks out and markets react, remember this: the market reacts, smart investors prepare. In every crisis, there's both danger and opportunity. Your task is to keep a level head, stick to your long-term strategy, and be ready to seize sensible opportunities when they arise. The world will always face challenges. Markets will always have ups and downs. But over time, human ingenuity, economic growth, and the power of compound returns have consistently rewarded patient, disciplined investors. So the next time conflict flares and markets tumble, take a deep breath. Review your strategy and remember, this too shall pass. Your future self might thank you for keeping a cool head while others lost theirs.